That feeling you get sometimes, like something's just not right, not quite adding up.
Yeah, yeah, I know what you mean.
You see the effects everywhere, the economy feels shaky, the world's on edge. But those root causes, they feel so distant and hazy, like some pieces of the puzzle are just missing.
Like you're trying to see the whole picture, but you're stuck looking through a foggy window.
Exactly. And if that feeling resonates with you, well, then you're definitely in the right place.
We've all been seeing these headlines. A massive corona relief fund. Then talk of another huge chunk of money for defense, the EU's next generation plan, energy prices all over the place, and this growing focus on, well, everything green and military spending.
It's a lot to take in, right?
Yeah.
And it can feel pretty overwhelming, to be honest. But here's the thing.
It's all tangled together. Those headlines, they're not separate issues. They're all connected.
Exactly. And that's exactly what we're going to untangle today. We've been diving deep into a fascinating conversation with Hester Bass. It's on YouTube.
And we're here to break it down for you. Pull out the most important insights.
Think of it as your cheat sheet for understanding the deeper mechanics at play. We're going beyond the surface level stuff, the headlines, and really getting into what's driving our economic reality.
Our goal is to give you a much clearer picture, connect those dots,
Yeah.
so you can see those bigger forces at work, the long-term issues that have been building up over time and got us to where we are now.
So, are you ready to dive in?
Let's do it.
All right. Let's start with something that might sound a bit technical, but bear with me, it's really important. It's this idea of a liquidity shortage in the banking system. Hester talked about how, for decades now, banks have basically been lending money for longer terms than the terms of the deposits they hold.
Yeah, it's like a mismatch in timing.
Right. And to manage all the risks that come with that, they've been using these really complex financial instruments called over-the-counter derivatives, specifically interest rate derivatives.
Now, we actually covered those derivatives in detail in a previous deep dive, so some of this might sound familiar. But it's worth revisiting because it's so crucial to everything else we're talking about.
Definitely. So the key takeaway is that this practice, this mismatch in lending and deposit terms, has created this significant onderpand court. And that basically means banks are promising more loans than they have readily available safe assets to back them up.
It's a collateral shortage.
Yeah.
And it's not small potatoes either. Hester actually gave some pretty shocking numbers. An estimated 200 billion euros in the Netherlands back in 2008. The real number ended up being even higher, something like 270 billion.
Wow.
Yeah. And across Europe, it was 2 trillion euros in 2008. And a report from the Korean Institute of Finance, they estimated a 3.5 trillion euro shortage in Europe by 2016. Tens of trillions globally.
So this isn't just a small hiccup in the system. This is a massive systemic issue. And this is where it gets interesting. You see, this huge lack of safe assets, the stuff you need to back up those loans, it directly fueled the push for things like Eurobonds.
Right, because they needed something to use as collateral.
Exactly. And initially, only bonds issued by Germany and the Netherlands, only those were considered reliable enough. That tells you something about the financial landscape at the time.
It really does. And it leads us right to the role that France played, especially during that 2008 crisis. France, they held some pretty key positions in European institutions at the time.
Like really key positions.
Trichet, he was at the Dutch Central Bank. Lagarde was the French finance minister. Sarkozy was the president of the EU. That kind of concentrated influence at a time when things were so fragile, well, it's pretty noteworthy.
It is. And Hester highlighted France's really strong interest in a new kind of monetary system, one built on, you guessed it, crypto, both CBDCs, central bank digital currencies, and privately issued cryptocurrencies.
And she pointed out how France was really, geazened, well-disposed towards the crypto industry very early on. They seem to be pushing it, supporting it.
Actively.
Yeah, actively.
Yeah.
And it's not just France. We have to look at how regulations are shaping the whole crypto space now. Take Circle, for example, the company behind the USDC stablecoin. They were the first to get a MiCA license in Europe last summer.
MiCA. That's a big one for anyone who's into crypto.
It stands for Markets in Crypto Assets. Basically, it's a whole set of new rules, new requirements for crypto providers in Europe. Trying to make things more, standardized, maybe offer more user protection, at least in theory.
Makes sense.
The full MiCA regulation, it kicked in this past December, and it means any crypto provider needs a European license to operate.
Okay, so let's connect this back to our earlier point about collateral. How does crypto fit into all of this?
So Hester explained that crypto, it can act as underpand. It can be used as collateral
Because
because it has decking. You can think of that as the underlying value backing it up.
Okay, so like it has something solid behind it, making it acceptable as collateral.
But, and this is a big but, she pointed out this crucial link back to traditional banks. Because even these crypto companies, they still need to hold their funds somewhere. And where is that? Usually it's accounts at good old-fashioned banks. It's not some completely separate, self-contained system.
And that brings us to Silicon Valley Bank. Remember that whole fiasco circle? They had a huge chunk of their reserves, something like 80%, held at SVB.
Yeah, and they ended up moving those funds to BlackRock just weeks before the bank went belly up. It almost makes you wonder if they saw the writing on the wall.
Right. Or maybe they just wanted more direct access to the Federal Reserve, bypass those intermediary banks entirely for safety.
Makes you think, doesn't it?
Mhm.
And it really highlights the risks involved, not just for crypto companies, but for all sorts of electronic money institutions, like the ones managing those gift card balances. When you have these massive sums of money sitting at these intermediary banks, it can get dicey.
It's not the same as stocks, right? Where, your ownership is legally separated from the brokerage's assets.
Right, that's a key difference.
So we're talking about trust here, right? A lot of trust in those institutions.
And it creates this tension. On one hand, you have this push for safer markets. Through mechanisms like netting and central clearinghouses, they're trying to consolidate risk. But the problem is they're consolidating assets too. So if one of those big clearinghouses fails, the impact could be huge.
A domino effect.
Exactly. It's the opposite of true asset segregation, where your assets are held directly, like in a peer-to-peer system, like Bitcoin.
Okay. So if we zoom out a bit, look at the bigger picture. What's the driving force behind all of this? Hester had some pretty strong opinions on that.
Oh yeah, she's not afraid to speak her mind.
So what's the big idea here?
Well, for her, the core driver is creating liquidity. It's about controlling the flow of money, centralizing assets. And of course, with that centralization comes power and more ways to monitor everything.
Power and control. That's a recurring theme, isn't it? And it brings us back to those massive spending plans we mentioned earlier. The 800 billion euro Corona Fund, and now this proposed 800 billion for defense. Hester connected these directly to this need for liquidity.
Yeah.
But it's not just about plugging holes in the system, right?
No, no. It's about this long-term ambition for a more unified Europe, a defense union, an energy union, a monetary union, deepening that integration.
It makes you wonder, right? Is there this kind of, I don't know, perverse logic at play where they need these crises, these perceived crises like climate change or, geopolitical conflict to push these agendas forward?
It's a valid question. And Hester touched on how these crises can be used to rally support across the political spectrum. Take climate change, for example. Those initiatives, they tend to resonate more with, let's say, left-leaning voters.
Right. They use different levers to appeal to different groups.
And it's interesting to see how certain individuals position themselves to, shall we say, benefit from these global shifts. Hester mentioned Al Gore and his financial gains from the climate agenda.
Right, right. And she also brought up Guy Verhofstadt. He was involved in that worst bank scenario as an APG commissioner back in 2008. Then he moved into the liquid gas sector with Exmar. And then he got involved in Ukraine. Those connections definitely raised some eyebrows.
Oh, yeah. It makes you think about who stands to gain from all of this. And Hester even introduced this concept of a transatlantic plan, going all the way back to 2007, 2008.
With Merkel, Bush, and Barroso.
Yeah, she suggested it was like a blueprint for a lot of the transitions we're seeing now. Ukraine, Palestine, energy policy shifts, developments in the Western Balkans, even how they handled the pandemics. And now, this framework seems to be expanding with Draghi's focus on space, AI, digitalization.
It's like they're building on this foundation, brick by brick. And speaking of transatlantic connections, it brings us to the whole Europe-US relationship. Now, you might get the impression, especially after, Trump's rhetoric, that Europe and the US are splitting apart.
Yeah, that they're decoupling.
But Hester, she had a different take on that. She emphasized how strong those financial ties actually are. BlackRock, Goldman Sachs, they're still major players on both sides of the Atlantic.
She even suggested that this appearance of separation, it might actually be, I don't know, a strategic move, a way to create this multipolar world with these distinct but still interconnected power blocks, each with their own currencies, a whole new global financial architecture.
It's like rearranging the furniture, but the house is still the same.
Exactly. And the goal of this new setup, she argued, is to provide global liquidity, to make it easier to invest internationally. But she also cautioned about the risks. What happens if those capital flows get messed up? Or if those clearinghouses, those massive interconnected clearinghouses, what if they become too big to save?
Too big to fail.
Too big to save. The potential for that domino effect, it's a huge concern. And it brings us to another crucial aspect, transparency and accountability. Or, should we say, the lack thereof.
Esther really hammered on this point. She pointed to the lack of transparency around the guarantees that the Netherlands has given to European institutions and funds since 2008. These off-balance sheet liabilities, the shadow banking activities, it's all very opaque.
She actually cited some pretty eye-popping figures from the Dutch budget memorandum, no less.
Yeah.
As of this year, we're talking 38 billion euros linked to Next Generation EU, 34 billion for the EFSF, 35 billion for the ESM, 32 billion for the IMF. The list goes on.
It's a laundry list of guarantees. 12 billion for the EIB, 14 billion for FMO, 4 billion for the SRF, 2.6 billion for the EFSM, and that's not even all of them. Another 3.7 billion for EU balance of payment support and 5.4 billion for the World Bank. That's a lot of potential obligations. And Hester explained how all of this underpins the ESM, the European Stability Mechanism, which is basically, the bad bank designed to handle failing institutions. And it raises a big question, especially for the Netherlands. With all these guarantees, these shared debts, how realistic is an exit at this point?
A Dutch exit from the EU.
Exactly.
With all those financial entanglements, it makes you wonder.
It does. And she talked about the influence of people like Schoof, the prime minister, who's got a long history with the PVDA, the Labour Party, and Bart LeBlanc from ABP, the pension fund. He was involved in those temporary fixes during the credit crisis. And now he's pushing for this public good economic model, which he says is similar to China's system.
And Hester, she pointed out how these public good initiatives, these NGOs, they can lead to situations where public money is basically being spent privately with very little accountability. She mentioned Mike Benson as a whistleblower in this context. And NL Invest, that investment fund with Wouterbos involved, there were concerns about oversight there too.
It's like, where does the public good end and private interests begin? It gets blurry.
Very blurry.
All right, let's shift gears a bit. Let's talk crypto again. It's often presented as this decentralized, revolutionary alternative to traditional finance. But Hester paints a more nuanced picture.
Yeah, she kind of punctures that utopian bubble a bit.
So what's the reality?
Well, the technology itself, the blockchain, yeah, that's decentralized. But the whole ecosystem around it, that's becoming increasingly regulated, integrated into the existing financial system. Initiatives like MiCA, that's a big part of it.
All those licenses, the KYC, the AML rules, it's definitely eating away at that anonymity that was so attractive to a lot of people. And the idea that crypto operates completely outside the traditional banking system, well, that's not entirely true either, is it?
Especially when you look at stablecoins. Like USDC, they rely on holding reserves at traditional banks like we saw with Circle and their whole SVB saga.
Well,
Even Tether, they reportedly hold a lot of government bonds managed through custodians. So they're still exposed to those risks within the traditional financial system.
And for those who might have put their hopes in Trump's pro-crypto stance, well, Hester suggested that position actually aligns with this whole agenda of regulating and integrating stablecoins, bringing them under control.
Which ultimately benefits, you guessed it, the established players.
It's like they're co-opting the revolution.
And let's not forget, the Netherlands has been regulating payment and electronic money services since 2011. So while customer funds are supposed to be held separately, those accounts are still at traditional banks. Another layer of connection, another layer of potential risk.
So no matter how you slice it, those banks are still right at the center of everything. Traditional finance, crypto, it all flows through them.
It does make you wonder about the true level of decentralization in this supposedly decentralized world.
And Hester made this really important distinction between crypto, the technology, and Bitcoin, the application. Bitcoin, it emerged right around the time of the 2008 crisis. It was this peer-to-peer alternative. But the big players, they quickly caught on. They saw the potential of the blockchain.
And they started building their own versions, more controlled versions, like the utility settlement coin or Goldman Sachs's HQLAX, trying to make their existing systems more efficient.
And now with all these regulations, it's becoming harder and harder to use Bitcoin for, everyday transactions.
It's almost like they're pushing it back into the fringes.
And all those speculative coins, the Trump coins, the Melanie coins, Hester called them what they are, shit coins. They might ride the hype wave for a bit, but they don't really change anything fundamental.
It's all about the underlying system. And that system, well, it's undergoing some pretty profound changes. Hester talked about how we've moved away from physical bearer shares,
Yeah.
where you physically held the certificate, you owned the
Yeah,
share.
it was yours.
We went from that to registered shares and now increasingly to this system where shares are held indirectly through these central securities depositories.
So we don't really have a direct claim anymore.
It's all based on trust. Trust in the banks, trust in the depositories, trust that they're keeping accurate records. Hester even mentioned the Dutch Wet Jural Effectenverkeer, the Securities Transfer Act from 2009, that really formalized this whole indirect holding structure.
So what does this mean for the future of money?
Well, with CBDCs, central bank digital currencies, people would hold digital currency directly at the central bank. Of course, there's talk of limits, at least initially. But if a lot of money moves out of those commercial banks and into those CBDCs, it could cause some serious problems for the banking system.
And events like the pandemic, with all that anxiety around touching cash, that could really speed up the adoption of digital currencies. It's interesting that there's this debate going on in the EU right now about the availability of physical cash, whether it should still be legal tender.
And Hester pointed out how cautious, even critical, a lot of East European countries are about all this. They've got that history with communism, that wariness of centralized control. She even told this story about driving through Eastern Europe and how cash was still king there. Nobody wanted to use anything else. And, you have to wonder, with everything going digital, what happens if there's a major cyber attack? You're relying entirely on digital records for proof of funds. It's a scary thought.
It is. And speaking of scary thoughts, Hester highlighted this development that's been in the works for a long time. The European Collateral Management System, or ECMS, it's a system run by the central banks.
And it's been delayed over and over again. It was supposed to launch way back in 2006.
16 years ago.
Yeah. And now they're saying it's finally going live this June. It's supposed to be a major piece of the puzzle, a crucial piece of infrastructure for this new financial system.
So what's the holdup?
Well, nobody really knows for sure. Hester mentioned technical issues, the possibility that they need a specific event to trigger it, or even, and this is where it gets really unsettling, the possibility that there's something they're not telling us, like fraud within the central bank's balance sheets. She mentioned that in a later update.
So we're in this waiting game. We'll see what happens in June.
The next 6 months will be telling. Will they push ahead, even if there are problems? Or will something break?
Hester emphasized the importance of individual resilience, strong communities. It sounds like we need to be prepared, both mentally and practically. She didn't give a doomsday timeline, but she definitely pointed to June as a key moment.
With all these interconnected systems coming online, it could cause some major shifts in liquidity. And it might become even harder to see what's really going on, what the true financial positions are. And let's not forget the push for a more integrated Europe. Hester emphasized that shared defense spending, shared investment, that's a primary driver, even if it's framed as a response to, events like the war in Ukraine.
She called the war a sideshow.
Yeah, compared to those fundamental financial and systemic changes, it's about maintaining the fiat system, gaining more control through digitalization, centralizing assets. And she raised a really unsettling possibility. Remember the asset stripping that happened during the credit crisis? The businesses that got gutted?
Yeah.
She said that could happen to individuals next, through adjustments to bank conditions, overvalued assets getting repriced. It's a sobering thought.
Well, that was a lot to digest. And if you started out feeling like something was off, well, I hope this discussion helped you understand why.
The key takeaway is that these things, they're all connected. Those headlines, those political events, those financial moves, they're not happening in isolation. They're driven by deeper forces, by long-term goals.
And understanding those mechanisms, that's crucial. It helps you become a more informed, more aware participant in the whole system. And Hester's analysis really underscored the importance of transparency, of questioning those increasing debts, of engaging with these complex systems instead of just passively accepting what we're told.
So here's a final thought for you. As we move towards more centralization, more control, more digitalization, what does true financial sovereignty actually look like? What role can we as individuals play in shaping that future? I encourage you to keep diving, keep asking questions, because the answers matter a lot.